Good morning, everybody. This is LinkedIn Live. This is our show, part four of the January Life Insurance 2023 series. Today, we're going to be rounding out the conversation for life insurance in a portfolio for a business owner. So, just a recap, in part one, we looked at how corporations from the major, say, Fortune 500 list have used life insurance in their portfolios. We took a look at Winn-Dixie, Walmart, and AT&T, and how they were buying massive blocks of insurance and placing the insurance into a trust and naming themselves as the beneficiary, right? And that was to give you a layout of the land, right? And in part two, what we looked at was how small businesses can do something of the same thing. And the reason why we looked at that for small businesses was because there's the experts have coined what's called the great resignation, right? And so the challenge is if you're a small business owner, how do you effectively recruit, retain, and reward your key employees, right? Your employees that are moving the needle in a substantial way to the business. How do you keep them from jumping ship and going to ABC Corporation on the Fortune 500 list, right? And in part three, what we looked at was how can permanent life insurance fit into your retirement planning portfolio, right? And we looked at a piece from Ernst and Young that just said when it comes to retirement planning, investments with an insurance chassis provides the optimal outcome in retirement. The reason why is because you take risk off of the table. You're not going to outlive your money, right? And you have a pool of money that grows tax deferred. And when you take the money out, it's tax free. So when your investments are down, you pull from the permanent cash value from your whole life insurance plan. And so part three, well, this is actually part four. Today, what we're going to be looking at is the tax incentives, right? The tax deductions that a business owner can take using an insurance chassis. So let's jump right in. We're going to go ahead and look at some of these articles, well, actually, these pieces from the IRS. Excuse me. So this first piece here, this is from directly from the IRS website. And so what we're looking at is what's called a fully insured plan, abbreviated 412E3. The only thing to take away from this IRS website today is that the 412E3 plan is what's known as what's called a defined benefit plan, which, to put it simple, is a pension. All right. One last quick thing I'd like to note is that these plans must be funded exclusively by the purchase of a combination of annuities and life insurance contracts or individual annuities. And so moving along to the contribution and deduction limits, for the sake of simplicity, I'm just going to give you an actual dollar sign And this is from, like I said, the IRS website. So if you are looking to have any of the links to today's stream, go ahead and drop me an email, or you can message me, send me a private message on LinkedIn, or email me. So here's going to be the contribution limits for 2023. An individual can deduct $265,000 for the year 2023. And for the year prior, 2022, you can deduct $245,000. And I'll highlight this so you can see this actual bullet point. So this is going to be the maximum limits that someone can contribute and deduct to their defined benefit plan. And so that's a massive benefit, right? Oftentimes when you're in business and you're thinking about your tax bill for the current year or the upcoming year, you're always thinking, what can I deduct? What can I, write off? And in some cases, not in all, owners begin to buy things that provide some utility, but maybe not the maximum amount of utility that is possible, right? You could be buying equipment, things of that sort. But with the defined benefit plan, this is something that you can write off for your retirement plan that has a massive deduction, and the benefit is tangible, right? It's a pension. It's a stream of income once you stop working. Moving along to the pros and cons of setting up a defined benefit plan, right? So this is on the IRS website also. So going down to, we're going to highlight 3 of the pros, a couple of the benefits. So number 1, substantial benefits can be provided and accrued within a short time, even with early retirement. What this means is, let's say you haven't been proactive as you could have been in earlier years, when you had a long runway to prepare. With the defined benefit plan, you're allowed to catch up. So you get to rest assured that, hey, even though I did not do what I could have done in prior years, what I should have done in prior years, I can catch up. And the sky can be blue for me. Second benefit is that employers can contribute and deduct more than other retirement plans. So bar none, a defined contribution, you cannot deduct anywhere near $200,000, right? So you're getting a massive deduction, right? And the third benefit is that the plan provides a predictable benefit. And as far as the cons go, we'll just go ahead and pick 3 also. These are going to be what the IRS is saying are the most costly type of plan, one of the most administratively complex plans, and there will be an excise tax if you contribute too much to the plan, right? If you overfund the pension plan for you. But I like to highlight something, and that's the deduction, right? So if you can deduct upwards of $200,000 of income, that can also qualify you for an additional 20% deduction. And this is what's known as your qualified business income deduction. So moving along to this slide right here, or this page from the IRS, this is what's called a QBI deduction. So I'm going to read this for you right here. Many owners of sole proprietorships, partnerships, S corporations, and some trusts and estates may be eligible for a qualified business income deduction, also called Section 199A, for tax years beginning after December 31st, 2017. We're going to shorten qualified business income for just QBI deduction, right? And so what this is saying is that if you own a pass-through entity or you have a trust and estate, you get to write off 20% of your income. Moving further along, the deduction allows eligible taxpayers to deduct up to 20% of their qualified business income plus 20% of qualified real estate investment trust dividends and qualified publicly traded partnership income. And so just to note, if you have deducted, let's just say $200,000 of income, right? And you are now within the income thresholds to qualify for this deduction, you can write off that original $200,000 and then take an additional 20% off of your total income. And you can, if you have any real estate investment trusts, these are called REITs, you can deduct 20% of those dividends. And there's even more. This 20% deduction is on top of your itemized deductions for the year. So this is, I gotta say, the best thing since sliced bread. You get to write off upwards of $200,000, set up a pension, and then qualify for an additional 20%. What is that? A rebate, you can think of it, 20% deduction on top of your usual itemized deductions. So that's going to be our show for today. So tying everything full circle, we covered how corporations buy life insurance, how small business owners can utilize the same things to recruit, retain, and reward key employees. Part 3, we looked at how life insurance or an insurance chassis fits in a retirement plan. We looked at a piece from Ernst & Young, how the insurance chassis provides the optimal retirement when it is included with your investment strategy. And then today we simply rounded off the corners by showing how the insurance chassis, you can use that to deduct over $200,000 from your reportable income and then take another deduction, which is called the QBI deduction, which is 20% on top of your usual distributions. So that's our show for today. I appreciate you all for tuning in. Take care and have a good one.